So as we begin our current liabilities, we're going to look at a brief overview of current liabilities and then also kind of walk through a basic notes payable situation. So first of all, we really do need to go back to the conceptual framework to recall what the definition of a liability is. Hopefully this is something that you covered in Intermediate 1 and we're just going to revisit it here. So the Financial Accounting Standards Board defines a liability as a probable future economic sacrifice of economic benefits arising from present obligations of a particular entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. It's kind of a mouthful definition, but that is actually what the standard lays out as a definition to liability. And it's actually really important that we lay out a specific definition because the definition that we use for liability has implications for both the balance sheet and it also has implications for the income statement as we start to record expenses related to liabilities. So in its simplest form, we take that sort of complex definition that we see in the conceptual framework and we break it down into three elements. The first element is that the settlement must involve a probable future economic sacrifice. So there must be a future economic sacrifice. You're going to see sort of three time-related aspects to this definition, and here's the future aspect, of future economic sacrifice. The obligation must be unavoidable, so there must be a present obligation. And finally, the transaction or event creating the obligation must have already occurred, so there must be a past transaction or event. So there's a future economic sacrifice, a present obligation, and a past transaction or event. If one of these three aspects of the definition is not met, then there is no liability. So let's then talk about the difference between current and non-current liabilities. So a current liability is one where the liability is settled with existing current assets, or the settlement will require the creation of new current liabilities. Again, this is the guidance that's provided under FASB, which is what they're the governing body that creates US GAAP. So let's use a very basic example potentially to highlight this idea of liabilities. So if a firm borrows from an outside entity, when do they incur interest expense, and what is the role of any stated interest rate? Well, first of all, we have to think about that the firm incurs interest expense as time passes. And the idea here as time passes is that now the obligation to pay increases because as they're accruing interest on the note, not only do they have to pay the amount that was borrowed, but now they also have to pay the amount of accrued interest. And so as that liability increases over time, the interest expense is being incurred also over time. Now there is a role for the stated rate because it does provide the contractual interest payment. So that's going to drive the actual liability itself. Ultimately, though, the interest expense is based on the most reliable market rate, which many times is the contractual interest rate, but does not necessarily have to be. And so if the interest rate from the market and the interest rate on the note are not the same, then the note will be offered either at a discount or at a premium. And so again, usually the stated interest rate or the contractual rate is going to be the same as the market rate, but that does not necessarily have to be the case. And so again, as that liability is incurred, you have an interest expense, but also there may be a premium or discount, and we'd have to amortize that premium or discount, which would also create an interest expense as time passes. All right, let's use an example. So Panther Company borrows $50,000 cash from 49er Bank and signs a $50,000 5% 6-month note on November 1st, 2019. The note matures 6 months later, and of course there is a fiscal year end. One thing to note here, because the firm raised $50,000 cash, that means that the contractual rate, which is 5%, is equal to the market rate. Otherwise, it would have been issued for an amount different than $50,000. And so we do have an initial entry. We have the cash that we receive, and of course now we have this unavoidable obligation to pay $50,000 at some point in the future. All right, so then the next part of this entry is at the end of the fiscal year, the company does have to accrue interest payable. Now, while they don't technically owe, they don't have to pay anything at the fiscal year end. The fact is the economic condition of the firm has changed, because now do they not only owe $50,000, but now they have to owe 2 months of interest that is accrued since the note was initially issued. And so we have to record the payable and, of course, simultaneously record the related interest expense. And so we can see $50,000 times the contractual interest rate is 5%. And of course, we accrued 2 out of 12 months. Since that is an annual rate, we would accrue $417,000. And so we have the credit to the interest payable and the debit to the interest expense. And so then on April 30th, 2020, the note matures. Not only do we have to pay the principal, but we also have to pay accrued interest. In addition to that, because time has passed, we need to record an additional interest expense. And so the interest expense for that remaining 4 months is, of course, 4/12 times 5% times $50,000, which is $833. And of course, the cash payment is the principal and 6 months of accrued interest with an annual rate of 5%. So in total, they owe $50,000 for the note payable and $1,250 for accrued interest. And so, of course, we have the interest expense, we have the interest payable that was previously accrued, and of course, we have the cash payment.